Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. If you are looking to level up your trading game and learn how to spot major market moves, then you have come to the right place, okay? In this particular video, we are going to be diving into one of the most powerful and effective strategies in Forex trading, and that is the volatility breakout strategy. Now, in as much as this strategy can be powerful and effective, it does not guarantee profit, okay? I need to make that clear, right? In this video, we are going to break down what volatility is, how to spot breakouts, and how you can use this strategy to potentially enhance your trades, okay? So make sure you stay tuned, and by the end of this video, you'll have all the tools you need to start trading volatility breakouts like a pro. All right, before we dive into the strategy itself, let us first talk about volatility. So what exactly is volatility in the Forex market? Volatility refers to the degree of price fluctuations, right? The degree of price fluctuations in the market is what we refer to as volatility, all right? So we refer to as volatility. It means the price is moving fast, up and down, fast, emphasis on fast. It's not a slow movement, right? It's a fast movement. That's what we refer to as volatility. It's often in bigger increments. Conversely, in low volatility markets, prices move slower and in small increments. Now, why does this matter for traders? The answer is simple. Volatility creates opportunities. When the market moves quickly, that's when breakout happens. And that's when you can potentially capture larger price movements. But of course, volatility isn't something to be scared of, right? It's something to be used to your advantage. That's where the volatility breakout strategy comes into play. Now that we understand volatility, let's dive into the breakout strategy itself. Now, a breakout happens, right? A breakout happens when the price breaks through a significant level of support or resistance, right? For example, we can see that we had a breakout level around here, right? Because we had a resistance level. We had a resistance level around here. You can see we had a resistance level around here, and then okay, this was a sort of this was an ascending triangle that we had here. We had an ascending triangle around here. So we had a breakout from this point, and then there was still, price coming back into the ascending triangle before we now had the main breakout again. Okay, so breakouts are powerful because they signal the potential for larger price movements, but they can also be tricky to identify and trade if you don't have a strategy in place. As you can see, when this breakout happened, you can see there was a large buy, there was a large price movement. Okay, so how do you trade volatility breakouts effectively? Where you likely avoid false breakouts. The first step is to identify key support and resistance levels, just as we did here. These levels are essentially price points where the market has previously reversed or stalled. Now, support is the price level at which the market tends to find buyers. For example, around here, this level was a support, okay? Because we are seeing rejections, rejections, and price was bouncing back to the upside, okay? So you want to focus on the strongest support and resistance levels. As you can see, I'm currently on the daily chart. The higher the time frame, the stronger the support and resistance levels, okay? And the more times the price has bounced off a particular level, the stronger that level usually is. Now, once you have identified these levels, you want to wait for the price to approach them, right? This is where you need to be patient. Don't rush into trades just because the market is moving quickly. It's crucial to wait for the price to either break above the resistance or below the support, right? Signaling that a breakout might be occurring. One important thing to note is that not all breakouts are created equal. Okay, sometimes the market will break a level briefly, only to reverse and head back in the opposite direction. Okay, it happens sometimes. That's what we call false breakout. Okay, and it can trap unsuspecting traders. So how do you avoid getting caught in these false moves? The next step is to look for volume or momentum confirmation. A true breakout is typically accompanied by an increase in trading volume or strong momentum. Now, when this happens, it's a signal that more traders are entering the market and the move is more likely to continue in the direction of the breakout. So if you see the price breaking above a resistance, like what happened here, and at the same time, there's an increase in trading volume, you can actually decide to use, any volume indicator of your choice. For example, I'm just going to add the volume indicator to the chart so that we can confirm an increase in volume, right? So can you see what happened here? We had a breakout around this point, right? And you can see there was a spike in volume because breakouts are usually accompanied by an increase in volume, okay? And then you can also use indicators like the ATR just to measure volatility. All right. For example, if you want to measure volatility, you can decide to use the average true range because average true range can show us volatility in the market, right? You can see how volatile, you can see around this place where we had a spike in volume, you can see how the ATR value also rose up, okay? So now that you've identified the breakout and have confirmation, it's time to set your entry point. This is where you actually execute the trade. You can enter once the price breaks the key level. For example, as this happened here, you could have considered entering once the price breaks the key level, or you can actually decide to wait for a small pullback to get in a better price. Both approaches can work, but it's up to you, okay? It's up to your risk tolerance and trading style. As always, it's essential to manage your risk, and that's where your stop loss comes in. A stop loss helps limit your losses if the breakout turns out to be a false signal. I recommend placing your stop loss just below the breakout level. For example, if you had entered a buy here, in this case, we had an ascending triangle, all right? So it's not this particular example because there are some breakouts that could be, you just have an exact horizontal movement like what we had here, an exact horizontal movement. In this case, we had a breakout to the downside, but in this case, what we had was an ascending triangle. So ideally, I'm going to recommend placing your stop loss below the triangle. All right, so in as much as you had a breakout here, place your stop loss below the triangle. It's going to be below this swing low, okay? And then after you have done that, the next step is to manage your trade and set your take profit. So it's crucial to have a target in mind when trading volatility breakouts. You can set your take profit based on key levels, such as the next level of resistance. For example, you can use resistant levels like perhaps this level or subsequent resistant levels that you can find, okay, depending on how long you want to hold your trade, okay, and how strong the new trend is, or the trend in the direction of the breakout is, okay? So that way you can capture as much of the move as possible, while protecting yourself from any potential reversal. You should be adjusting your take profit levels, okay, as the price is going in your direction. Now, before we wrap up, I want to quickly touch on a few common mistakes traders make when using the volatility breakout strategy. First, don't chase breakouts. It's tempting to jump in as soon as you see a price move. But remember, waiting for confirmation is key. Second, make sure you are trading during high volume sessions, like during major market openings. And then low volume breakouts can often fizzle out. So pay attention to that, okay? Lastly, make sure you are properly managing your risk. Even though breakouts can lead to big moves, not every breakout will be successful, okay? So stick to your strategy and don't let emotions drive your decisions. To sum it all up, the volatility breakout strategy is a nice strategy for capturing big moves in the Forex market. By understanding volatility, identifying key levels, confirming the breakout with volume or momentum, and managing your trade carefully, you can increase your chances of success with this strategy. If you found this video helpful, make sure to hit the like button and subscribe to the channel for more in-depth trading tips and strategies. We post new content every day and you don't want to miss it. As always, happy trading, and I'll see you in the next video.